I think it's just too coincidental to have gold versus the S&P breakout in November, silver versus gold breakout in November, silver versus GDX breakout in November. You get the point?
Yeah.
It's trying to tell you something.
Where there's smoke, there's fire, for sure.
And it's just begun. It's the other main point to make. We're not near the end of something. We're at the beginning of it, and we are arguing that don't be shocked if it's like those lead and the copper moves. It's a logarithmic scale swing. I'm betting at least 200. But 200 for silver. But on the other hand, when you look at the charts we've looked at, 500 would be, hey, you match the 50-year range. Big deal.
No, I think 500 is feasible. I mean, it's definitely on the upper end of the confidence curve, of the confidence interval, but it's not out of the realm of possibilities, for sure.
Silver has entered a phase in 2025 that few market participants expected to unfold this rapidly. Year to date, the metal is up roughly 140%, an extraordinary performance for an asset long dismissed as gold's volatile cousin. Over just the past week, silver has accelerated sharply, pressing higher almost session by session, absorbing profit-taking with ease, and pushing decisively into new price territory. That advance culminated in a fresh all-time high near $69.80 per ounce, confirming that this is no longer a slow grind higher, but a momentum-driven move with strong underlying demand. In his latest analysis, Michael Oliver gives a detailed framework explaining why this move is happening now and why it may still be in its early stages. Oliver is not focused on headlines or narratives. He is focused on structural signals, particularly silver's behavior against gold, against the equity market, and crucially, against M2 money supply. From these relationships, Oliver argues that silver has the technical capacity to move substantially higher, potentially into the first quarter of 2026, with a base case target near $200 and a higher-end scenario of $500 per ounce. In today's video, we'll walk through the specific signals Oliver is watching, why silver miners may be positioned to outperform not just gold, but gold miners themselves, and how this entire setup intersects with his expectations for a prolonged and destabilizing equity market decline. If you value disciplined technical analysis applied to real macro conditions, make sure to like the video and subscribe to the channel. This is a critical moment for precious metals, and the framework matters more than the headlines. We appreciate the support and hope you enjoy the video.
This is gold divided by M2.
Yeah, well, look at that breakout pending. In fact, look at that. That's another interest. You see the pivotal nature of that 2011 peak. Look to your left, and you'll see there was, you got it. You break out of that, where are you going? You're not going to crawl, I'll tell you that. You're not going to crawl.
Mm-hmm. You got another doubling inside. It looks like it.
Yeah, whatever. It'll leave the earth in price terms.
About 3x, actually. Yeah.
So don't be shocked by what happens, but especially don't be shocked if it happens quickly.
Here's silver. Here's silver, Michael. Look at that.
What if you just went to that 2011 high? It's
about a double.
Yeah.
Get back to that.
Just to even go there, okay? Mm-hmm. So you get the point. But the key for MSA right now in telling our subscribers that it's going to be compressed. It's highly likely to be a very compressed event. And such that, let's say those guys who are all fearful of a stock market break, which we argue is going to happen and it's going to be bad. Are not arguing a crash. Crashes are rare in bear markets, in fact, in the stock market. 2000, 2002, I don't think there was a crash. Okay, but it's probably not going to really start in a way that the doubters, I say doubters, those who doubt the mining stocks, those who doubt silver because, they got to go down if the stock market goes down. What if the stock market doesn't go down right now? What if it diddle-dawdles around until we get into second quarter? Okay, that's December, January, February, March, 4 months into a potential 6-month explosion, let's say, a la the copper chart, a la the lead chart. You get the point. So a lot of assumptions out there. And first off, that assumption about the weakness of miners versus the stock market, for example, is inverted now. It's not the same case. I think I included a chart to deal with that. Here is XAU versus gold is very,
XAU versus gold. Well, this is HUI versus M2 money supply.
That's good. Yeah. See, the miners are doing quite well. Yeah. They're not even halfway back to their highs. Yeah.
Controlling
Yeah.
for the M2 money supply.
Yeah.
And
Well,
the problem with the HUI, it only goes back to 97. You don't even
XAU
have
goes back to the 80s. XAU goes even further back. But,
okay, let's type that in then. This one?
yeah, hit that. See what happens here. It goes back to the 1980s. And,
oh, nice. There you go.
now, yeah, there's a downtrend you could plot there. See that? Hoo-hoo. What just happened? What just happened?
We just broke out.
And plus, you had a 10-year wide range there at the bottom. What are you going to do? Go to zero? Okay. You had a 10-year wide range at very suppressed levels, and you broke out of that about months ago, and the downtrend at the same time. And what have you done? You've gushed. No surprise.
Yeah. So that's
now, if you can do,
4X.
I've got a chart of one of the reports of XAU versus gold, which I think is quite informative.
This one?
Yeah, no. Keep going. Before that, there you go. That's it. This goes back to the 1980s, and this is the price of XAU, Philadelphia Gold and Silver Miners Index, divided into an ounce of gold using the front month futures each month. And you can see it lived in a range from about 17.5% up to over 35%. It lived in that range for decades, up and down. Yeah, there were times it was better, times it was worse, but net on balance, sideways for decades. That circled month there, the red circle, occurred in September of 2008. Okay, now think back. The nightmare vision that everybody has in their mind that when the stock market breaks down, miners have to go with it. Well, back then, that was the case. Gold broke sharply into October of 2008, a month after that circle occurred between gold miners and gold. But in a month before the collapse in the stock market, the miners, and also a sharp drop in gold, the miners blew out a multi-decade support line relative performance, saying, I'm now going to be weaker than gold. The next month, S&P had a crash-like month, October. Miners had a bad month in October. And gold finished its decline in October and turned around, made new highs by early 2009. Okay. But the miners stayed depressed, and it took them a whole year or more to get back to their highs. Why did they suddenly become anemic to gold versus gold? Well, this spread tells you. They blew out a multi-decade support line of relative performance. And so from that 2008 September close to 2015, the spread went down. In other words, it underperformed gold. Yes, there was a period there when miners finally went up and made a marginal new price high in 2011. But at that point, the spread went up and bumped the bottom of the range. Couldn't get back above that which it broke. And then continued down through 2015 on the spread, which is also when the price of gold and miners made a bear low, 2015. Since then, the miners have performed par to gold, meaning in that green range. They've gone up, they've gone down, but basically they're at the upper end of that range now, meaning they've actually done better relative to where they were at the bear low in 2015. So if you go back to XAU price in 2015 and look at it now, it's multiple, it's higher than gold is, relatively speaking. But if that spread now, and we're pushing at that green line right now, if you break out over the top of that range, it's the inverse, or the opposite of that breakdown in late 2008, when gold miners shifted to underperform versus gold. This time they're about to break out of very low levels to an outperform status. They've already broken out of her downtrend line, similar to the one you just showed a minute ago of XAU versus money supply. They did this versus gold. This is back in early 2024. They did that, I think, early 2025. And they surged up to the top of the range. If you clear the top of that range, and you're pushing at it now, you've got nothing to stop you, technically speaking, until you get back up to around that red line, the bottom end of the multi-decade range. Treat it like a price chart. That would be resistance. But that's more than a doubling from where you are now. Meaning if this breaks out, I don't care what the stock market does, the miners are now in a strong position relative to gold, and also they've broken out versus the S&P already above a similar basing pattern. So the miners aren't weak compared to the stock market and gold. They're about to become the strongest component, stronger than gold even, in the monetary complex. And they've got, you could double and a half just to get to the red line. Might not look impressive, but it would be highly impressive in terms of percentage gain. So our bias at MSA is, yes, gold market's the mama, it's leading, it's going a lot higher, but you want to be in silver and you want to be in the miners. And in particular, my emphasis is silver miners.
Picking up from Oliver's first key chart, the relationship between gold and M2 money supply provides essential context for what is unfolding beneath the surface. Gold priced against expanding money supply has reached a pivotal breakout zone that mirrors previous periods of rapid repricing. Oliver emphasizes that when these breakouts occur, price does not advance slowly or methodically, it accelerates. The implication is not merely higher nominal prices, but a revaluation driven by monetary debasement itself. Silver, viewed through the same lens, appears even more compressed, suggesting that its recent surge may represent only the initial phase of a broader repricing cycle rather than a terminal move. From there, Oliver extends the analysis into the mining complex, introducing relative performance charts that challenge a long-held assumption that miners must underperform during equity market stress. The early signals he highlights, particularly silver miners relative to gold miners, suggest that this cycle may invert historical patterns. The setup he outlines points to a rotation already underway, one that favors leverage to silver rather than defensive positioning within gold alone.
Go to SIL versus GDX. I think you'll see something else there. We don't watch the J too much. Okay, this is, you've broken out above that recent range. Is this weekly or what? Monthly?
Monthly. Do you want the candlesticks? I can put the candlesticks on.
That's okay. Anyway, there's a channel that we plot of that action since 2022 when it dropped sharply into 2022 there, back right there, yeah. And then you had a rally right after that. Look at the green candles, the up candles. You'll notice you can connect the line over the peak closes. No, not there. It's starting in 2023 or 2022. That first re-up. Go a little more to the left. That high, that green candle, that top green candle to your right. Okay, right. Crosshairs move over to the right. There you go. One more.
This one?
That one, yeah. Now connect that green candle peak. There you go. Look where you are. Breaking out above the close only peaks.
Mm-hmm.
1, 2, 3, 4 hits on that line, and you broke out marginally last month, and you're gaining more this month. So this argues that likely that not only are miners going to beat gold, as we saw in that other chart, but silver miners are going to beat the gold miners. They're vastly undervalued versus the gold miners, just like silver is relative to gold. And I think the biggest slingshot effect among the miners will be in the silver miner. And this chart clearly has shown for 3 or 4 years now that it's basing. It just doesn't want to go any lower, okay? And you broke out of that lovely little downtrending channel. I think it's just too coincidental to have gold versus the S&P breakout in November, silver versus gold breakout in November, SIL versus GDX breakout in November. You get the point?
Yeah.
It's trying to tell you something.
Where there's smoke, there's fire, for sure.
And it's just begun. It's the other main point to make. We're not near the end of something. We're at the beginning of it, and we are arguing that don't be shocked if it's like those lead and the copper moves. It's a logarithmic scale swing. I'm betting at least 200. But
200
again, 200 for silver. But on the other hand, when you look at the charts we've looked at, 500 would be, hey, you match the 50-year range. Big deal. We're entering not a normal bull phase here for silver. And we're, even though we're only in the middle of a normal bull phase for gold, 4-fold versus 2 8-folds, okay? Silver's only just starting, and every slingshot we look at has been pulled, just pulled. Hence, it's just begun. The stock market, while it is topping in a laborious way, but go back and look at 2007. Go back and look at we got bearish in January of 2000. You can punch up an S&P chart if you want. And you look at the price action in 2000 to 2001, for example. 2002, yeah. There. If you could widen that to look at it a little better. In January of 2000, it was dropping into the mid 1400s, and we got bearish. That first red candle there, that one there, yeah, that's January. Dropped into February, then shot up in March, made a new high. Okay, we said be gone in January. Okay, at an average around 1450 price. Okay, went up, made a new high in March, pull back again, still wouldn't go down. Came back up in August and made a new high monthly close. So 2 new highs after we said get out. And yet they were, so what? Low double digit percent, like 10% further gain. And then it wasn't until 2001 that you finally started to come apart. And in fact, in that first big old January 2001, The Fed cut rates twice in the same month. And they cut rates all the way down, and yet the stock market imploded. Yeah, you see when it drops off there, where the Fed fund rate starts to drop. Yeah, that was when the market started to roll over. Okay, all rate rises end in mid 2000, and it wasn't until early 2001. Well, that's when the stock market started to implode. They cut rates all the way down. Did it help the stock market?
Not at all.
No. Monetary metals went up. Okay, and in 2007, that's another interesting chart, and we analyzed it versus annual momentum. 2007. Okay, there you go. In the end of 2006, we were about 1,400. Oh, what you got there? Yeah, 1,400 price. 1,400 price. Yeah. No, further back to the left. Yeah, 2006. Close of 2006. December. Yeah, we put out a report late that month. We were above 1,400. We said we're going to go up into next year, and we're going to top. And our prediction was it would peak at 1,550 to 1,600 zone. Okay. Now, if you could look at a couple of months to your right, in the summer of 2007, you got up to above 1,550 intra-month. You got above there. And you got sold in too hard into the summer, into August. Had a hard drop there 2 months later. And then you came back up again in October and took out the summer high. Went to 1576, right in the middle of our target zone. All-time new high, because that first high in 2007 stopped where the high in 2000 had stopped, 1550. So when you came up in October and got the 1576 for a price guy, that was a triple top breakout. 1550 in the year 2000.
And it was about 2 months removed from when the Fed started cutting rates in August.
Yeah, they cut rates.
August was the first time.
I know mid-September was when that rate cut occurred, actually, and it was a surprise. It was a half point. And the market rallied for the next several weeks into October, and that's what produced the new high. Mm-hmm. A surprise first rate cut in a long time. And if you sold into that rate cut, yeah, you got hurt by another 50 to 100 S&P points, but basically you sold the top. And they cut rates all the way down, as you can see. Did it stop the stock market from going down? So the question is, why is it the stock market bulls out there are so happy to anticipate Fed rate cuts? Why do they think it's good?
Historically, it's not.
Yeah, technically it's not, and fundamentally it means even the guys at the Fed who always love to talk like quiet wizards were panicked.
What stands out most in Michael Oliver's outlook is not a single price target, but the consistency of evidence across multiple markets and time frames. Silver versus gold, silver versus miners, gold versus the S&P, and each of these assets versus money supply are all delivering aligned signals. When multiple independent relationships break out simultaneously, Oliver treats that not as coincidence, but as confirmation. This kind of convergence historically precedes sustained advances rather than short-lived spikes, particularly when those advances are rooted in monetary expansion rather than speculative excess. Central to this thesis is monetary debasement. The expansion of money supply over the past decade, and its acceleration through crisis-driven policy responses, has steadily eroded the purchasing power of fiat currencies. Gold and silver are not reacting to fear alone, they are responding to arithmetic. When money supply grows faster than productive output, price levels must eventually adjust. Oliver's charts frame this adjustment visually, showing how suppressed metals prices have lagged far behind the scale of monetary expansion. Silver, in particular, appears to be correcting years of underperformance in a relatively short window. The mining sector adds another layer of leverage to this environment. Oliver's analysis shows that miners, especially silver miners, have already broken long-term downtrends relative to both gold and the broader equity market. Unlike in 2008, when miners collapsed alongside equities, today's structure suggests improving relative strength even in the face of stock market weakness. If this breakout continues, miners may no longer be passengers to metal prices, but leaders within the precious metals complex. That distinction matters for capital allocation, particularly for investors seeking asymmetric upside. Equally important is Oliver's perspective on the broader market cycle. He does not argue for an immediate crash, but for a prolonged, grinding equity decline, similar to past secular bear markets. History shows that rate cuts often coincide with worsening market conditions rather than recovery, and that monetary metals tend to perform best when confidence in policy tools erodes. In that context, silver's volatility becomes a feature rather than a flaw, offering both monetary protection and speculative upside in a system increasingly strained by debt and intervention. Taken together, Michael Oliver's analysis presents a coherent and optimistic framework for silver, gold, and the miners, not based on hope, but on structure, ratios, and long-term technical evidence. If this cycle unfolds as his work suggests, silver's recent breakout may be remembered not as the peak, but as the opening chapter of a much larger revaluation. If you found this analysis valuable, please like the video, subscribe to the channel, and share it with others who are closely watching the precious metals space. Thank you for watching, and I'll see you in the next one.